Ladies and gentlemen, Asian guy here. I need you to stop scrolling through your portfolio right now. I need you to put down your phone and listen to me very carefully, because while you were celebrating New Year's, while you were making resolutions and nursing hangovers, the global financial markets just delivered a message that changes everything we thought we knew about the 2026 investment landscape. And if you don't understand what happened in the first 48 hours of this year, if you don't see the patterns that are forming right now across London, Hong Kong, Seoul, and New York, you're going to make decisions that will cost you a fortune. Let me show you the numbers. On January 2nd, 2026, London's FTSE 100 index broke through 10,000 points for the first time in its 42-year history. It didn't just edge over the line, it exploded through the barrier, surging 1.0% to reach an intraday peak of 10,046.3. This is a milestone that has eluded British markets since the index was created in 1984. 42 years of waiting, 42 years of climbing. And it happened on the second trading day of 2026. But if you think that is impressive, look east. Hong Kong's Hang Seng index catapulted 2.8% higher to 26,338.47. This marks the strongest opening to a trading year since 2013. Not 2023, not 2024, 2013. We are looking at 13 years of history being rewritten in a single session. South Korea delivered the most violent move of all. The KOSPI shattered records by climbing 2.27% to close at an all-time high of 4,309.63. The index broke through the 4,300 threshold for the first time around 2:30 in the afternoon, Seoul time. It hit an intraday peak of 4,313.55 before settling slightly lower. Samsung Electronics, the semiconductor giant, soared 7.17% to 128,501. SK Hynix jumped 3.99% to 677,001. Both stocks hit record highs. Both stocks are at the epicenter of the artificial intelligence infrastructure build-out that is consuming the global economy. And then we have the United States. NASDAQ 100 futures advanced 1% in early trading. The S&P 500 futures jumped 0.6%. The Dow Jones Industrial Average futures rose 0.43%. Technology stocks, specifically artificial intelligence-related names, are leading the charge across every single continent. Do you see what is happening here? This is not a regional phenomenon. This is not Europe doing its thing while Asia does something else and America watches from the sidelines. This is a synchronized global rally. This is every major equity market on the planet moving in the same direction at the same time, driven by the same narrative. And that narrative has a name: artificial intelligence. Now, the skeptics watching this are already typing in the comments, Asian guy, this is just a continuation of the bull market. This is just momentum. This is just algorithms chasing price. You are sensationalizing normal market behavior. But you need to understand what you are actually looking at, because this is not normal. This is not business as usual. And what we are witnessing right now in the opening 48 hours of 2026 is the market making a binary bet. The market is betting that artificial intelligence is not hype. The market is betting that the $400 billion being spent annually on AI infrastructure is not a waste. The market is betting that the technology companies, the semiconductor manufacturers, the cloud service providers are all going to monetize this investment and turn it into profits that justify valuations that are currently sitting at 22.4 times forward earnings for the S&P 500. And here is the terrifying part. Wall Street is unanimous. Not a single one of the 21 strategists surveyed by Bloomberg News predicts a downturn for the S&P 500 in 2026. Not one. The average forecast suggests an additional 9% gain for the coming year. That means an S&P 500 year end target around 7,463. Every single bank, from Goldman Sachs to Morgan Stanley to Bank of America to Deutsche Bank, is bullish. Every single strategist is projecting gains. There is not a single dissenting voice in the chorus. Now, think about what that means. Think about the implications. When was the last time you saw a unanimous agreement on anything in the financial markets? When was the last time every expert, every analyst, every institutional desk agreed on the direction of travel? It doesn't happen. Markets are battlegrounds. There are always bears and bulls fighting for territory. There are always contrarians taking the other side of the trade. But right now, at the beginning of 2026, there is no other side. Everyone is on the same side of the boat. And that, my friends, is either the greatest validation of a bull thesis in history, or it is the setup for the most spectacular collapse since the dot-com bubble. Because history teaches us one undeniable lesson. When everyone agrees, when consensus becomes universal, when there are no bears left to convert into bulls, that is when the market is most vulnerable. That is when a single crack in the narrative can cascade into a total structural failure. Ed Yardeni, a veteran market strategist who has been bullish for years, who has a 7,700 S&P 500 target for 2026, which implies 11% upside, recently said something that should make every investor pause. He said, "That is my main worry right now. Things have gone my way so long, it is worrying that everyone else seems to have become believers too. Pessimism is just not in vogue right now." Read that again. The most prominent bull on Wall Street is worried that everyone else has become bullish. He is worried that his own thesis has become consensus. Because he understands the game, he understands that markets move on surprise, on change, on shifts in sentiment. And when sentiment is already priced at maximum optimism, there's only one direction left to travel. So what we need to do right now in this video is dissect exactly what is happening beneath the surface of this rally. We need to look at the data that the mainstream media is not showing you. We need to examine the structural forces that are either going to propel markets to new heights or trigger the correction that will wipe out trillions of dollars in paper wealth. Because this is not a time for blind optimism. This is a time for surgical precision. This is a time to understand exactly what you own, why you own it, and what could destroy it. Let's start with the foundation of this entire rally. Let's talk about the one technology, the one narrative, the one belief system that is holding up the entire global equity market right now: artificial intelligence. According to JP Morgan Asset Management Analysis, AI stocks have accounted for approximately 75% of S&P 500 returns since ChatGPT launched in November 2022. 75%. Think about what that number means. It means that 3/4 of all the gains in the largest, most diversified equity index in the world have come from a single sector, driven by a single technology trend. It means that if you strip out the artificial intelligence names, if you remove NVIDIA, Microsoft, Google, Amazon, Meta, Apple, and Tesla, the rest of the market has been essentially flat for 3 years. This is not broad-based growth. This is not a rising tide lifting all boats. This is a narrow, concentrated, AI-driven rocket ship that is pulling the entire index higher while the majority of companies tread water. And that concentration creates a very specific type of risk. It creates the risk that if the AI narrative breaks, if the thesis gets challenged, if investors lose confidence in the monetization potential, the entire market collapses in sympathy. Because there is nothing holding it up except the belief that artificial intelligence is going to revolutionize every industry and generate trillions of dollars in new economic value. Now, let's look at the money. Let's follow the capital flows. Because numbers don't lie. Goldman Sachs research reports that consensus estimates among Wall Street analysts for the hyperscaler AI companies' capital spending in 2026 now stand at $527 billion. $527 billion. That is up from $465 billion at the start of third quarter 2025 earnings season. That means that in the span of a few months, Wall Street analysts raised their capital expenditure expectations by $62 billion. They are not cutting estimates. They are raising them. Companies are not pulling back. They are accelerating. Microsoft is aggressively expanding Azure AI capabilities. They have partnership commitments to OpenAI that are driving substantial capital expenditure. Google is building out data centers and developing custom tensor processing units to reduce their dependence on NVIDIA. Amazon is pouring money into AWS infrastructure to maintain cloud market leadership. Meta is spending billions on AI research and infrastructure, despite having no clear path to monetization in the near term. These are the 4 horsemen of the AI infrastructure build-out. And they are not slowing down, they are speeding up. But here is where it gets interesting. Here is where the story shifts from exciting to terrifying. Goldman Sachs research notes that since June 2025, the average stock price correlation across large public AI hyperscalers has declined from 80% to just 20%. Do you understand what that means? It means that for the first 3 years of the AI boom, all the big tech stocks moved together. If NVIDIA went up, Microsoft went up. If Microsoft went down, Google went down. They were perfectly correlated because the market viewed them as a single trade, a single bet on artificial intelligence. But starting in June 2025, that correlation broke. The stocks started moving independently. Some went up while others went down. And that dispersion, that divergence, tells you something critical. It tells you that investors are no longer buying the sector. They are picking winners and losers. They are asking hard questions. Which companies are actually generating revenue from AI? Which companies are just spending money? Which business models are sustainable? Which ones are speculative fantasies? And this brings us to the single most important number in the entire AI investment thesis. The number that will determine whether we are in the early stages of a transformational bull market or the late stages of a speculative bubble. That number is the infrastructure to revenue gap. Hyperscalers committed nearly $400 billion in capital expenditure in 2025. Meanwhile, enterprise AI generates approximately $100 billion in actual revenue. $400 billion in spending, $100 billion in revenue. Do the math. That is a 4-to-1 ratio. For every dollar of AI revenue generated, companies are spending $4 building the infrastructure. Now you might say, Asian guy, that is how technology adoption works. You build the infrastructure first, you lay the fiber optic cables, you build the data centers, you manufacture the chips, and then the applications come later. The revenue follows the investment with a lag. And you would be right. That is exactly how every technology cycle in history has worked. The railroads were built before the freight arrived. The internet infrastructure was built before e-commerce exploded. The mobile networks were built before the app economy took off. But there is a problem. There is a very specific, very dangerous problem with the current AI investment cycle. And that problem has a name. It is called the failure rate. An MIT study found that 95% of generative AI pilot programs fail to achieve business value. 95%. Only 5% of enterprises report significant EBIT impact from AI investments despite widespread adoption. 78% of organizations now use AI in some capacity, but only 5% are making money from it. Let that sink in. Let that number penetrate your understanding of what is happening right now. 3/4 of companies have deployed artificial intelligence in some form. They have hired data scientists. They have bought GPU clusters. They have subscribed to cloud AI services. They have integrated chatbots, recommendation engines, predictive analytics, natural language processing. And 95% of them are not seeing a return. 95% of them cannot point to their income statement and show you where AI generated incremental profit. This is the nightmare scenario. This is the thing that keeps the bears awake at night. Because if enterprises are spending billions of dollars on a technology that doesn't move the needle on their bottom line, how long do you think they're going to keep spending? How long before the CFO walks into the CIO's office and says, "Show me the ROI, or we are cutting the budget"? How long before the pilot programs get shut down? How long before the AI consultants get fired and the GPU subscriptions get canceled? And when that happens, when the enterprise demand dries up, what happens to Microsoft's Azure revenue? What happens to Amazon's AWS growth? What happens to Google Cloud? What happens to NVIDIA's data center revenue, which currently represents 85% of their total sales? The entire artificial intelligence infrastructure build-out is predicated on the assumption that eventually, someday, somehow, enterprises are going to figure out how to make money from this technology. But what if they don't? What if the use cases are more limited than we think? What if the productivity gains are offset by the implementation costs? What if artificial intelligence is genuinely transformative for a narrow set of applications, like drug discovery and climate modeling and fraud detection, but doesn't revolutionize every single industry like the bulls are projecting? If that turns out to be true, if the monetization fails to materialize at the scale required to justify $400 billion in annual spending, then we are not in the early stages of a transformational cycle. We are in the late stages of a capital misallocation bubble. And the correction, when it comes, will be biblical. But we are not done yet, because there is another layer to this story. There's another data point that crystallizes the risk better than anything else, and that data point is OpenAI, the company that started this entire frenzy, the company that released ChatGPT in November 2022 and convinced the world that artificial general intelligence was imminent, the company that everyone on the planet is trying to emulate. OpenAI is reportedly seeking to raise up to $100 billion at a potential valuation of $830 billion. $830 billion. Let me give you some context for that number. That valuation represents approximately 167 times OpenAI's projected 2025 revenue. 167 times. For comparison, the most expensive software companies in the world, the high growth, high margin, best-in-class SaaS businesses, trade at 10 to 20 times revenue. The magnificent 7 tech giants, the most profitable companies in human history, trade at roughly 5 to 8 times revenue. But OpenAI wants you to believe they are worth 167 times revenue. But it gets worse. Reports indicate that OpenAI's annual cash consumption will rise from $17 billion in 2026 to $35 billion in 2027, potentially peaking at $47 billion in 2028. $47 billion in cash burn in a single year. To put that in perspective, that is more than the entire annual revenue of companies like Starbucks or General Motors. OpenAI is going to burn through more cash in 1 year than most Fortune 500 companies generate in revenue. And here is the question that nobody wants to answer. Where is that money going to come from? Microsoft has already invested billions. Multiple sovereign wealth funds have participated in funding rounds. But how many more funding rounds can you do before the investors start asking when they are going to see a return? How many more years can you burn $47 billion annually before people realize that the business model does not work at this scale? The Economist identified OpenAI's cash burn as one of the big bubble questions of 2026, noting that the company's extraordinary capital consumption raises fundamental questions about the economic sustainability of frontier AI development. And they are right. Because if the company at the center of the AI revolution, the company that everyone views as the leader, the company that has the best technology and the smartest people and the most capital, if that company cannot figure out how to turn a profit, what does that tell you about everyone else? What does that tell you about the hundreds of AI startups burning through venture capital? What does that tell you about the enterprise software companies bolting AI features onto their products and calling it innovation? It tells you that we might be in the grip of collective delusion. It tells you that the emperor might not be wearing any clothes, and it tells you that when reality finally catches up to expectation, the reckoning will be swift and merciless. Now, let me show you something that the mainstream media is completely ignoring. Let me show you the signal that flashed over the holiday week that changes the entire competitive landscape of artificial intelligence. While everyone in the West was celebrating Christmas and New Year, while the markets were closed and the traders were on vacation, something happened in China that has profound implications for every single dollar being spent on AI infrastructure. Chinese AI startup DeepSeek released its V3.1 model. This model was built at a fraction of the cost of OpenAI's models, using far fewer NVIDIA chips, and it matches the capabilities of the most advanced large language models in the world. But here's the kicker. It was specifically optimized to run on Chinese-made chips, chips that are not subject to US export controls, chips that China can manufacture domestically without needing permission from Washington. Do you understand what just happened? Do you see the implications? For 3 years, the entire Western AI industry has operated under a very specific assumption. That assumption is that building cutting-edge AI requires massive GPU clusters, that you need tens of thousands of NVIDIA H100 chips, that you need to spend billions of dollars on compute infrastructure, that the barriers to entry are so high that only the largest, richest, most well-funded companies can compete. DeepSeek just proved that assumption is wrong. They built a model that performs equivalently to GPT-4 and Claude 3 using a fraction of the resources. And they did it using chips that cost a fraction of what NVIDIA charges. This is not incremental improvement. This is a paradigm shift. This is proof that the capital-intensive approach is not the only path. This is proof that efficiency matters more than scale. And the response from the Chinese tech giants was immediate. Baidu, Alibaba, Tencent, and Huawei rapidly integrated DeepSeek models into their cloud platforms. Baidu Cloud started offering the model with price cuts up to 80%, along with 2-week free trials. They are not trying to maximize margins. They are trying to maximize adoption. They are trying to make AI so cheap, so accessible, so easy to deploy, that enterprises have no excuse not to use it. This is the nightmare scenario for the Western hyperscalers, because their entire business model is predicated on being the only game in town. Their entire valuation is based on the assumption that if you want cutting-edge AI, you have to rent compute from Microsoft Azure or Amazon AWS or Google Cloud, and you have to pay premium prices because you have no alternative. But if DeepSeek and the Chinese cloud providers can offer equivalent capabilities at 20% of the cost, what happens to the Western pricing power? What happens to the margins? What happens to the $400 billion in capital expenditure that was supposed to generate monopolistic returns? It evaporates. The entire thesis evaporates. Because suddenly AI is not a scarce resource controlled by a handful of American companies. It is a commodity available from multiple sources at competitive prices. And when a technology becomes a commodity, the margins collapse, the valuations collapse, the stock prices collapse. Baidu's stock surged 9.35% on January 2nd. The market understands what this means. The market understands that the cost efficiency revolution is going to shift competitive dynamics. And the market is betting that the companies on the receiving end of the AI spending boom, the companies that benefit from cheaper, more accessible models, are going to outperform the companies that are spending hundreds of billions building infrastructure that might become obsolete. But we need to zoom out. We need to look at the bigger picture. Because while the AI narrative dominates headlines, while everyone is obsessed with ChatGPT and NVIDIA and data centers, there is another crisis brewing beneath the surface that could derail this entire rally before the year is halfway done. And that crisis has to do with the one component that every single piece of AI infrastructure depends on: memory chips. A severe memory chip shortage has emerged as one of the most significant supply constraints facing the technology sector in 2026. Samsung Electronics quietly raised prices on certain memory chips by as much as 60% compared to September 2025 levels. 60% in 4 months. This shortage affects DRAM, NAND flash, and high bandwidth memory. And it is creating bottlenecks even when other components are available. The root cause is simple. Artificial intelligence infrastructure is consuming memory at unprecedented rates. Every GPU cluster needs massive amounts of high bandwidth memory to feed the processors. Every data center needs enormous DRAM capacity to handle the workloads. Every smartphone, every PC, every server is now being designed with more memory because AI applications are memory intensive. The demand has exploded, but the supply has not kept pace. TrendForce analyst Ellie Wang expects Samsung to push quarterly contract pricing 40 to 50% higher in Q4 2025, well above the 30% industry average. And here is the scary part. SK Hynix has already booked its entire memory chip capacity for 2026. The entire year, they're sold out. If you're a company that didn't lock in your memory supply 6 months ago, you are out of luck. You're going to pay spot market prices, which are skyrocketing, or you're not going to get the chips at all. Counterpoint research projects that smartphone shipments may decrease by 2% in 2026, not because people don't want smartphones, because manufacturers cannot get enough memory chips to build them. Analysis suggests basic PCs will see price increases of approximately $96 due to memory costs alone. NVIDIA's upcoming RTX 50 series gaming GPUs could see production and sales delays because the cards require significantly higher memory content than previous generations. Do you see the cascade? Do you see how the shortage ripples through the entire technology ecosystem? It doesn't matter if NVIDIA has the best GPU architecture in the world, if they cannot get the memory chips to pair with the processors. It doesn't matter if Apple designs the most beautiful iPhone, if they cannot source the DRAM to make it function. It doesn't matter if Tesla builds the most advanced self-driving computer, if the memory shortage prevents them from manufacturing at scale. This is a supply chain choke point. And supply chain choke points have a very predictable effect on stock prices. They crush margins. They delay product launches. They force companies to miss revenue guidance. They create inventory gluts in some areas and shortages in others. They wreak havoc on just-in-time manufacturing. And they give analysts the excuse they need to downgrade estimates and cut price targets. We are already seeing the early signs. Gartner reports that DRAM will remain in undersupply until Q1 2026, driven by continued strong demand from AI servers, smartphone DRAM content increase, and inventory buildup for legacy DRAM. But Q1 2026 is right now. We are in the shortage right now, and it is not getting better. It is getting worse. The DDR4 phase-out is compounding the problem. As major suppliers accelerate transitions to DDR5 and shift mature node capacity toward HBM production for AI applications, DDR4 supply faces particular pressure. Estimates suggest DDR4 could face a shortfall of around 50,000 wafers by the end of 2025, with 2026 unlikely to fully close the gap. This means that older generation products, the budget smartphones, the entry-level laptops, the industrial equipment that still uses DDR4, these products are going to become more expensive or unavailable. And that is going to ripple through emerging markets, through price-sensitive consumers, through businesses that were counting on affordable hardware to roll out their digitization plans. This is the hidden crisis. This is the thing that is not priced into the January 2nd rally. The market is celebrating AI breakthroughs and record index levels. But the market is not pricing in the component shortage that could strangle growth before it happens. Now let's talk about NVIDIA, because NVIDIA is the anchor. NVIDIA is the bellwether. If NVIDIA goes down, the entire curtain comes down with it. One Reddit investor perfectly captured the sentiment, noting that NVIDIA being the anchor stock is no surprise. They are the canary for AI. If they falter, the whole curtain is coming down with them. And they are right. NVIDIA is not just another semiconductor company. NVIDIA is the physical manifestation of the AI thesis. If you believe in AI, you own NVIDIA. If you doubt AI, you short NVIDIA. The stock is the purest expression of conviction in the technology. NVIDIA derives 85% of revenue from just 6 customers. 85%? The top 4 customers account for nearly 60% of sales. Think about that concentration risk. Think about what happens if any one of those customers, Microsoft, Amazon, Google, Meta, decides to slow down their capital expenditure, or decides to shift spending toward custom chips instead of NVIDIA GPUs, or decides that DeepSeek style efficiency means they need fewer processors than they originally planned. If any one of those decisions happens, NVIDIA's revenue collapses. And if NVIDIA's revenue collapses, the entire semiconductor sector collapses. And if the semiconductor sector collapses, the technology sector collapses. And if the technology sector collapses, the S&P 500 collapses, because remember, 75% of gains since late 2022 have come from AI stocks. This is not diversification. This is not a balanced market. This is a house of cards built on a single thesis, with a single linchpin stock dependent on 6 customers continuing to spend at an accelerating rate indefinitely. And the moment one of them blinks, the moment one of them signals even a modest slowdown, the entire structure becomes unstable. NVIDIA trades at approximately 44 to 47 times trailing earnings and 24 to 26 times forward earnings. Those are elevated multiples. But here's the thing. They are not dot-com bubble insane. Cisco traded at 472 times earnings at the peak in 2000. NVIDIA at 47 times trailing is expensive, but it is not absurd if the growth continues. The problem is that the growth depends on continued capital expenditure acceleration from 6 customers in an environment where the return on investment is questionable, the efficiency alternatives are emerging, and the memory chip shortage is constraining production. That is a lot of risk factors that all have to resolve positively for NVIDIA to justify its current valuation and deliver the returns that bulls are expecting. And if even one of those risks crystallizes, the stock does not decline gracefully. It gaps down violently because it is held up by momentum and narrative rather than diversified fundamental support. Bank of America. His November research note estimated NVIDIA's fiscal year 2026 revenue at $212.83 billion with non-GAAP EPS of $4.66. But NVIDIA is already facing headwinds in non-data center segments. Gaming revenue missed consensus by 4% in Q3, with rumors of production cuts up to 40% in 2026 due to VRAM supply issues. Automotive segment missed consensus by 6%, with Q4 guidance significantly lower at $592 million versus consensus $700 million. So the only thing holding NVIDIA up is the data center business. The AI chips going to the hyperscalers. If that segment disappoints, if demand softens, if pricing comes under pressure, there is no cushion. There are no other divisions to pick up the slack. The entire company is a single bet on continued AI infrastructure spending acceleration. And this brings us to one of the most important catalysts of 2026, NVIDIA's Vera Rubin chip launch. Bank of America analysts identify this as the defining moment of 2026. If the Vera Rubin line delivers the promised performance and efficiency uplifts, it will destroy doubts regarding NVIDIA's supremacy. It will extend their technology lead. It will lock in customers for another product cycle, and the stock will go significantly higher, potentially to $200 or beyond. But if there are delays, if there are performance shortfalls, if the chips do not deliver the leap that was promised, or if customers decide the improvement is not worth the upgrade cost, that will create an opening. An opening for AMD, an opening for custom silicon from Google and Amazon, an opening for companies to say, we don't need the latest and greatest. We can make do with the last generation technology at half the price. And that narrative shift, that change in perception, will crater the stock. So Vera Rubin is not just a product launch. It is a referendum on the AI arms race. It is the moment where we find out if the spending continues to accelerate or if we have reached the plateau. Now let's zoom out. Let's look at the macro picture, because none of this exists in a vacuum. Interest rates matter, economic growth matters, inflation matters, geopolitics matter, and all of these variables are flashing warning signs that the January 2nd rally is choosing to ignore. The Federal Reserve delivered 3 rate cuts totaling 75 basis points in 2025, bringing the federal funds rate to a range of 3.5 to 3.75%. But the December 2025 meeting signaled a more cautious approach. The Fed is now projecting only 2 quarter-point reductions in 2026, down from 4 cuts previously anticipated. That is a hawkish pivot. That is the Fed telling you that they are not comfortable easing as aggressively as the market wants. Why? Because core PCE inflation remains above the 2% target. Because services inflation is particularly persistent. Because unemployment remains relatively low, suggesting there is no emergency requiring aggressive easing. Because wage growth continues above levels consistent with 2% inflation given productivity trends. And because the Fed is worried about potential inflationary impacts from tariffs and immigration restrictions. Mark Zandi from Moody's predicts 3 rate cuts in the first half of 2026 alone, arguing that economic cooling will proceed faster than the Fed currently anticipates. But the Fed disagrees. The Fed is saying 2 cuts for the full year. That is a massive divergence. That is the market pricing in easier financial conditions than the central bank is signaling. And when the market and the Fed disagree, the market usually loses. Because the Fed controls the policy. The Fed sets the rates. The market can hope and wish and price and whatever it wants. But if the Fed does not cut, rates do not fall. And if rates stay higher for longer, that has implications. It means that the discount rate applied to future cash flows stays elevated, which compresses valuations. It means that companies with high debt loads face higher interest expenses, which eats into earnings. It means that consumers with credit card debt, mortgage debt, auto loan debt feel more pain, which reduces spending, which hurts corporate revenue. It means that speculative assets, like unprofitable growth stocks and cryptocurrencies, lose their appeal because the risk-free rate is attractive enough to compete. Higher rates are kryptonite for expensive growth stocks. And right now, the most expensive growth stocks in the world are the AI names. If the Fed only delivers one cut instead of two, or if they deliver 0 cuts and actually hold steady, the AI trade is in serious danger. Because the only reason investors are willing to pay 28 times earnings for the Magnificent Seven is because they believe rates are going lower, making future growth more valuable. But if rates do not fall, or if they fall less than expected, the math changes. The valuations become unjustifiable. The rotation out of growth and into value accelerates, and the narrow leadership that has held up the indices for 3 years suddenly collapses. President Trump has indicated he intends to replace Fed Chair Jerome Powell with a more dovish appointee when Powell's term expires in May 2026. This could inject massive uncertainty into monetary policy. While markets might initially celebrate the prospect of easier money, concerns about Fed independence could paradoxically increase risk premiums. Because if investors believe the Fed is being politicized, if they believe monetary policy is being set to benefit the administration rather than to achieve price stability, confidence in the dollar erodes. Confidence in Treasury bonds erodes. Long-term interest rates rise even as the Fed tries to cut short-term rates. This is the nightmare scenario, a yield curve steepening driven not by growth expectations, but by inflation expectations and currency devaluation fears. The Supreme Court is expected to rule in January 2026 on Trump's attempt to dismiss Fed Governor Lisa Cook. Additionally, a ruling on the legality of reciprocal tariffs could have major fiscal implications, potentially forcing refunds to importers and creating budget shortfalls. These are political wildcards. These are events that could trigger volatility spikes regardless of corporate fundamentals or AI momentum. And then we have the economic growth outlook. Most economists expect the U.S. economy to avoid recession and grow moderately in 2026. But Moody's places recession probability at approximately 42%, well above the 15% healthy economy baseline. Bloomberg consensus surveys suggest 2% GDP growth with 30% recession probability. Those are not comforting numbers. Those are coin flip odds. The labor market is softening. Hiring has slowed. Layoffs have increased. Financial analyst Gary Shilling notes that labor markets here are atrophying with declining hiring coupled with rising layoffs. That is the early warning signal of recession. It is not panic time yet, but it is caution time. It is time to watch the unemployment rate very carefully. Because once unemployment starts rising, it tends to rise quickly. And once consumers start losing jobs, spending collapses. And once spending collapses, corporate earnings collapse. And once earnings collapse, stock prices collapse. Consumer debt has reached record levels, $18.6 trillion. Credit card delinquencies are at 11-year highs. Buy now, pay later debt, the BNPL products that do not show up on traditional credit reports, has exploded. Regulators are worried about phantom debt that could trigger a crisis. Because if consumers are stretched to the breaking point, if they are barely making minimum payments, the next shock, whether it is job loss or a medical emergency or car repair, pushes them over the edge into default. And when default rates spike, lenders pull back. And when lenders pull back, spending craters, and the whole system seizes up. This is the macro backdrop that the January 2nd rally is ignoring. The Fed is less dovish than hoped. The economy is showing cracks. Consumers are over-leveraged. Geopolitical risks are elevated. And yet the stock market is priced for perfection. It is priced for continued AI spending acceleration, for corporate earnings growing 15%, for no recession, for successful Fed soft landing, for geopolitical stability, for memory chip shortage resolution, for NVIDIA Vera Rubin success, for enterprise AI monetization, for everything going right simultaneously. What are the odds that everything goes right? What are the odds that not a single one of these risks materializes? History suggests the odds are low. History suggests that when markets price in perfection, reality delivers disappointment. And the disappointment triggers volatility. Sometimes the volatility is just a correction, a 10% pullback that creates a buying opportunity. But sometimes the volatility is the beginning of a bear market, a 20 to 30% decline that lasts 12 to 18 months and recalibrates valuations back to historical norms. So which is it? Are we in the early stages of a transformational bull market that will carry indices significantly higher throughout 2026? Or are we in the final manic phase of a speculative bubble that will pop spectacularly before spring? The answer depends on one thing: monetization. If enterprises figure out how to make money from AI, if the 95% failure rate drops to 70%, then to 50%, if companies start reporting that AI generated 10% revenue growth or 20% cost savings. The thesis is validated, the spending continues, the stocks go higher, the rally extends. We reach 8,000 on the S&P 500, we reach 300 on NVIDIA. The bulls were right, the bears were wrong, the skeptics look foolish. But if monetization continues to lag, if the MIT study proves prophetic, if enterprises start cutting AI budgets because the ROI is not there, then the $400 billion in spending collapses to $200 billion. And if spending gets cut in half, NVIDIA's revenue gets cut in half. And if NVIDIA's revenue gets cut in half, the stock gets cut in half. And if NVIDIA gets cut in half, the Magnificent Seven get cut in half. And if the Magnificent Seven get cut in half, the S&P 500 drops 25 to 30%. Because remember, AI stocks have driven 75% of gains. Take that away, and there's nothing holding up the index. This is the binary outcome we are facing in 2026. This is why the unanimous bullishness on Wall Street is so dangerous. Because everyone is positioned for the first scenario. Everyone is long, everyone is exposed. If the second scenario unfolds, there is no one left to sell to. The exits are crowded, the bid disappears, the cascade is unstoppable. Dean Baker of the Center for Economic and Policy Research warns Newsweek that the most significant risk to the U.S. economy is the bursting of the AI bubble. The loss of trillions in stock market wealth will lead to decreased consumption. Additionally, due to high leverage associated with both AI and cryptocurrency, we will likely witness considerable stress within the financial system. He's not talking about a correction. He's talking about systemic stress. He's talking about leverage unwinding. He is talking about margin calls and forced liquidations and credit market freezes. He is talking about the kind of event that requires Federal Reserve intervention to prevent cascading defaults. And here's the thing. If that scenario plays out, the Fed will intervene. They will cut rates aggressively. They will restart quantitative easing. They will inject liquidity into the banking system. They will do whatever it takes to stabilize markets. But by the time they act, the damage is done. By the time they ride to the rescue, your portfolio is down 30%. By the time they flood the system with liquidity, the psychological damage is inflicted. Investor confidence is shattered. The buy the dip mentality that has worked for 3 years stops working. People sell the rallies instead of buying them, and the market enters a prolonged period of volatility and uncertainty. So what do you do? How do you position for this binary outcome? How do you protect yourself from the downside while maintaining exposure to the upside? First, you recognize where you are. You are not at the beginning of the AI revolution. You are 3 years into it. You're not getting in early, you are getting in late. That does not mean you should not participate. It means you should manage risk aggressively. It means position sizing matters. It means stop losses matter. It means diversification matters. If you want exposure to AI, you should have it. But it should not be 70% of your portfolio. It should be 20%, maybe 30% if you are particularly bullish. The rest of your portfolio should be in assets that will not collapse if AI disappoints. Assets like value stocks, trading at reasonable multiples with real earnings and dividends. Assets like international markets that are trading at 30 to 50% discounts to US markets. Assets like commodities that benefit from the energy demands of data centers regardless of whether AI monetizes. Assets like cash and short-term treasuries earning 4 to 5% yields with zero volatility. Second, you watch the data. You watch enterprise AI spending. You watch corporate earnings, calls for mentions of AI ROI. You watch capital expenditure guidance from the hyperscalers. If Microsoft, Amazon, Google, or Meta signal even a modest slowdown in AI infrastructure spending, you reduce exposure immediately. You do not wait to see if it is just one quarter. You do not wait to see if the stock dips and bounces. You take profits and you protect capital. Because if one of them blinks, they all blink. And if they all blink, the cascade begins. Third, you prepare for volatility. Carson Group's Ryan Daytrick warns that market pullbacks can be particularly painful in the second year of a presidency. Since 1950, second-year drawdowns have averaged approximately 15%. That is not a crash, but it is not fun. It wipes out 6 to 9 months of gains in a few weeks. It tests your conviction. It forces you to decide if you believe in the thesis enough to hold through the pain, or if you want to cut losses and preserve capital. History shows that the year following a second-year tumble has delivered 31.7% average returns for the S&P 500, significantly better than average returns after drawdowns in other years of the cycle. So if we do get a correction in 2026, if we do see 15% decline, and if you have the conviction and the capital to buy the dip, the setup for 2027 could be extraordinary. But you have to survive the correction first. You have to have liquidity available to deploy. and that means not being fully invested at the top. Fourth, you pay attention to sector rotation. After 3 years of technology dominance, there are signs that leadership is broadening. Financials are showing strength, industrials are showing strength, energy is showing strength. These sectors are not expensive. They are trading at or below historical averages, and they have earnings growth accelerating as the economy continues to expand. If you are concerned about technology valuations, but you do not want to go to cash, rotating into these sectors provides equity exposure with better risk reward. The FTSE at 100 weaponize projected 5.5% cash yield from dividends and buybacks exemplifies the income opportunities available outside the US-UK banks. Energy companies and consumer staples offer compelling dividend yields with reasonable payout sustainability. European markets are cheap. Emerging markets are cheap. These are not momentum trades. These are value trades. They will not double in 6 months, but they probably will not cut in half either. And in an environment where the downside risk in U.S. technology is escalating, preservation of capital becomes more important than maximization of returns. Fifth, you avoid leverage, you avoid margin debt, you avoid leveraged ETFs, you avoid options with short expiration dates. These are tools that magnify returns when you are right, but they magnify losses when you are wrong. And at current valuation levels, at current levels of consensus optimism, the probability of being wrong has increased substantially. This is not the time to get aggressive. This is the time to get defensive. This is the time to make sure that if the correction comes, you do not get wiped out. Because if you survive the correction with capital intact, you can buy the bottom. You can participate in the recovery. You can compound wealth over the next decade. But if you get wiped out, if you blow up your account chasing momentum into the top, you are done. You are out of the game. You're watching from the sidelines while others profit from the rebound. The stock market opening of 2026 delivered a powerful message. It said that risk appetite is strong. It said that artificial intelligence is still the dominant narrative. It said that investors are willing to pay premium valuations for exposure to transformational technology. London breaking 10,000, Hong Kong surging 2.8%, South Korea hitting record highs, NASDAQ futures jumping 1%. These are all signals of bullish sentiment. But sentiment is not the same as fundamentals. Sentiment can change instantly. Sentiment can reverse on a single disappointing earnings report, on a single Fed comment, on a single geopolitical headline. Fundamentals take time to build. Fundamentals take time to erode. And right now, the fundamentals are sending mixed signals. Corporate earnings are strong, but valuations are elevated. Economic growth is positive, but recession risk is non-trivial. AI spending is accelerating, but monetization is lagging. The rally is real, but the risks are equally real. This is not the time for complacency. This is not the time to assume that what worked for the last 3 years will work for the next 3 years. Markets evolve. Narratives shift, leadership rotates, and the investors who succeed over the long term are the ones who adapt. The ones who recognize when the environment is changing. The ones who take profits when euphoria peaks. The ones who buy when fear peaks. The ones who manage risk more aggressively than they manage returns. We are at a critical juncture. The synchronized global rally that opened 2026 has set the stage. Now we wait to see which scenario unfolds. Do the bulls maintain control and drive indices to new highs? Or do the bears finally get their moment as reality fails to meet expectations? The answer will reveal itself in the coming weeks and months through corporate earnings reports, through Fed policy decisions, through economic data releases, through memory chip supply developments, through enterprise AI spending trends, through geopolitical events. Your job is not to predict which scenario unfolds. Your job is to position yourself so that you can profit in either scenario, or at minimum, so that you do not get destroyed in the adverse scenario. The game is rigged, yes, but for the first time in 3 years, it might not be rigged in your favor. The unanimous bullishness, the elevated valuations, the narrow leadership, the concentration risk, the monetization gap, the memory shortage, the Fed uncertainty, the economic fragility, these are all warning signs. Heed the warnings. Protect your capital. Manage your risk. Stay disciplined. Because the opening of 2026 was a celebration, but celebrations do not last forever. Eventually, the music stops. Eventually, someone turns on the lights. Eventually, you have to look around and assess whether you are holding real value or empty promises. Make sure you know the difference before the market teaches you the lesson the hard way. The greatest wealth transfer in history is unfolding. But wealth does not flow to those who chase the highest valuations at the peak. Wealth flows to those who buy low and sell high. Wealth flows to those who have the discipline to take profits when everyone is euphoric and the courage to buy when everyone is terrified. Wealth flows to those who understand that markets are cyclical, that bubbles always pop, and that preserving capital through the downturn is more important than capturing the last 10% of the rally. The 2026 rally is real. The AI revolution is real. The opportunities are substantial. But so are the risks. Navigate with caution. Trade with discipline. And remember that in markets, the goal is not to be right. The goal is to survive. Because if you survive, you get to play another day. And if you play long enough, eventually the odds shift back in your favor. I am Asian Guy, and this is the most important year of your investment life. Do not waste it chasing euphoria. Use it to build wealth that lasts. Subscribe, share the video, and I will see you on the other side.